Well, you could probably consider today the calm before the storm. Of course, tomorrow we've got the big Federal Reserve announcement on whether they're going to be cutting interest rates or not. And today was just a little bit of a breather for most market participants as we didn't really move around with a whole lot of volatility. In fact, all of the major market indices stayed within their average true ranges. We did have one big story today, and that was oil prices. Oil prices, after surging yesterday, fell back down pretty significantly today as it was reported that Saudi Arabia would have some of their repairs done faster than normal. So we'll take a look at all of that, see what it means for our posture. We'll then take a look at an application example around that oil-themed idea. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's September 17th, 2019. First of all, if you are new, welcome aboard. Remember to go over to YouTube, click on subscribe. While you're over there, check out our description area and make sure you sign up for our email distribution list. We're also heavy users of Twitter. My handle is @BrandonVanZee if you want to follow me there. And we certainly appreciate those of you that click like and retweet for our Market Outlook related posts. Lastly, we have a presence on Facebook as well. We'd invite you to join us at the group embedded in the logo in front of you. All right, let's go ahead and dive into the charts. As you can see, I've got chart 4B pulled up here in front of us. This is just a 4 grid to try to get a sense of whether the stocks look the same in the various quadrants of the market, whether you're talking about the small caps from the Russell 2000's perspective, whether you're talking about the mega caps from the Dow Jones perspective, whether you're talking about the general stock market with the S&P 500, or whether you're talking about more of the technology and growth-oriented companies with the NASDAQ composite. As you can see, the charts look fairly similar right now. We did have some sort of a differentiation on a one-day basis that is worth mentioning. The Russell 2000, you'll note here, did close lower today. We were down 0.40% on the Russell 2000, whereas if you look at the returns on the rest of the market, we actually finished in the positive territory. In fact, we had the exact inverse of that on the NASDAQ composite, where we closed up 0.40%. That was actually a nice little bounce higher right there out of the NASDAQ as well. Nice little close above the high of the low day that we're dealing with. So perhaps a bounce candidate there going into tomorrow's Fed decision. The S&P 500, we closed higher by 0.26%. Note that we did close above that key 3,000 reading. For a lot of technicians, that's an important area, so it's impressive we were able to hold that despite some of the news stories we've been dealing with in the last couple of days. And then the Dow Jones closed higher by just 0.13%. But as you can see, the background colors of all of these charts are still that darker shade of green, telling us that we have a strongly bullish intermediate posture. In addition to that, we also have this moving average colored green. And remember, that is a 30-day moving average that we're using on this particular chart. But that's a good sign because it tells us price is above a rising moving average. So all in all, things are holding fairly steady as we head into tomorrow's Federal Reserve decision. And of course, David will be back with you tomorrow in the video to help sort through any of the insight that he gained from listening to the Fed here on Wednesday. I'll, of course, be teaching my factor-based swing trading class at exactly the moment that they make that decision. It seems like we've been in the habit of that. It just happens to be that I teach that class on Wednesdays at 2 p.m. Eastern Time, and that's exactly when the Fed usually comes out with any sort of interest rate decision. So we'll look forward to seeing how the markets react to that starting as soon as tomorrow. Let's go ahead and take a look at another chart here. While we're looking at it, let's go ahead and pop up the 3 green arrows chart. Just as a quick heads up, we do have 3 green arrows in all 4 of our charts here currently. That's nothing new. We've had that condition really for the last couple of weeks for the most part. So again, markets holding up reasonably well as it stands here going into the Fed decision. And for those of you that are trend traders, generally speaking, if you have the markets from a broad perspective giving you a 3 green arrow signal, then perhaps there's some interesting choices from an individual stock level from a trend trading perspective as well. In fact, we had a very interesting choice in yesterday's top-down trend trading class that I teach on Mondays at 11 a.m. Eastern Time. And we got into a brand new industry yesterday after some of this rotation has been taking place within the market. So and that stock has been up for the last couple of days. So thankful we grabbed it while we could. So anyway, we are starting to get a little bit stronger trend trading conditions here for those of you that use kind of that 3 green arrow philosophy. Looking at another chart setup now, let's take a peek here at our longer term view, which is the 1040 crossover method chart. And as you can see, things look reasonably strong across the board. We do have 3 out of these 4 charts with a green background color, and that green background color denotes when we have a 10-week moving average, which is listed in the orange color, above the 40-week moving average, which is listed in the blue color. That is not the case quite yet on the Russell 2000. However, you will note how close we are. Look down below here, this little line. In fact, let me right click and go to maximize cell so we can kind of see this in a better screen here. And you can see that this purple line down below is approaching this black horizontal 0 line here. And when that does cross over, that's kind of the point, the intersection where that orange 10-week moving average does cross up and through the blue 40-week moving average. So this is the small cap universe. We're getting awfully close to getting a bullish crossover. Some of you might refer to that as a golden cross. However, keep in mind that the Russell 2000 has been a bit different than the other 3 indices from this chart's perspective. Remember, this particular chart goes back over 3 years, but it gives you a sense of how choppy things have been for the small caps. We've been up in this area 3 different times here within just the calendar year of 2019. We were there at the end of February. We were there at the end of April. We were even there one more time here at the end of July, and we're approaching that level yet again. And you'll note that had you been buying the Russell 2000 as we had this bullish crossover right here where the chart went from pink to green, and then also again over here when the chart went from pink to green, that has not benefited you. This has been a market that has been more prone to whipsaws, where you get in late and you also get out late if you're setting stop losses on the backside. So be a little bit more cautious around that. Remember, these technical indicators are not going to work 100% of the time. What you're hoping for is a move like we saw back here. You know, from 3 years ago till about this moment here in September of 2018, that was an extraordinary run where we didn't have any of that whipsaw action where the chart went from green to pink to green to pink. So that's the type of thing you're hoping for, but of course the market's not always going to deliver that to you. And this year, unfortunately, has been more of that chop and slop sideways. So even if we do get a green background color here within the next couple of weeks on the Russell 2000, just be a little bit more hesitant and leery around it, just considering that the last few times we went to a green background, it didn't really do us any favors there. So we'll see if this time is different or not, but that's where we stand with things. Whereas the other charts, we've had a bullish posture, going back all the way since the beginning of this year and have continued to maintain that. All right, let's go ahead and do a little bit of 12 grid analysis now. And so I'm going to come on over here and go over here to my first set of 12 grids, which is my asset classes. Now, one thing I did want to point out, I've been in the process here for the last couple of weeks of restructuring our charts. I had a couple of questions about this, so I thought I would take a moment to address it. We're rebuilding several of the charts. We're relabeling, reordering several of the charts. We're even building some brand new charts. When it's all said and done, we'll have 46 customized charts. And so you can see a number of them listed here. For those of you that are premium members of Market Scholars from a yearly perspective, so in other words, if you have our 3-year premium membership, I will be sending out an email to you by the end of this week on instructions on how you can upload all 46 of these new charts for yourself as well. So again, just a reminder that you are going to have to be in the premium yearly version of our plan, not the monthly version, the yearly premium. Right there is where you get access to all those charting scripts. So again, be on the lookout for that. By the end of this week, you should have all of those new ones to import into your own Thinkorswim platforms. Since we're over here on the internet, let me just take a quick moment to say thank you to those of you that clicked like for me the last time we did the video here, which would have been about a week ago. Looks like about 119 of you clicked like for me there. We really appreciate that, especially when we get up and over 100. It helps us make it feel like it's been worthwhile for us to take the couple of hours out of our day to do these videos for you. So if you do get value out of hearing David and I's analysis of the various things that are going on in the market on a daily basis, make sure you do click like for us there. On Twitter, you can also do it right over here on Facebook if that is your social media platform of choice. But remember, on Twitter, that's where David and I do the vast majority of our analysis. That is kind of our primary social media tool. So that's kind of what we'll use to gauge our success or lack thereof when we're doing things like these videos or different pieces of content like the sector selector or dividend growth investments or 9 at 9 or all the different things that we do. So if you do get value out of the things that we provide for you, we would encourage you to follow us on Twitter and make sure you're clicking like and retweet when appropriate. Whenever we do these market outlook videos, we generally post that particular video to the top of our timeline on Twitter. So you can either do it here on our website, click down below here and click like, or you can go directly to Twitter and just look David or I up and just look at the top of our timeline. Otherwise, you can look at the description area within YouTube itself. We'll have a link directly to the tweet in question. And then lastly, if that's not enough, we also send it out via the email. For those of you that are signed up for our email distribution list, we have a link to the Twitter tweet on there as well. So there's really 4 different places where you could go to click like for us on Twitter. So we try to make it as easy as possible for you guys that will go out of your way to do that for us. And thank you. We really do appreciate that. Helps us reach a wider audience than we would be able to on our own. So thank you very much. Earlier today, I did teach my dividend growth investing class. We did concentrate on the healthcare sector. Remember, the dividend growth investing class, along with David's technical analysis class on Fridays, are part of the Plus subscription that you can sign up for, and you can actually do a 30-day free trial on the monthly version of that if you want to sign up for just the Plus version. You're not going to get all those chart scripts that I mentioned before, but it can at least give you a sense of what are the types of things we talk about in our trading room. So if you wanted to give us a try and just sample some of the things that we do for our students, feel free to sign up for that monthly Plus subscription where you get that first 30 days for free, and the dividend growth investing class is part of that, as you can see listed right there. So again, that is now posted on our calendar. Feel free to check out the recording and listen to my analysis on the healthcare sector. In terms of what's coming up, we do have David's class tomorrow morning, the options inventory trading class, where he gets into iron condors and diagonal spreads and all that kind of fun stuff. So feel free to join him at 11 a.m. Eastern Time if you are a premium member of Market Scholars. And then I'll have my factor-based swing trading class tomorrow, right when the Fed's decision is coming out, 2 p.m. Eastern Time. So we'll look forward to that. We've had quite the hot streak in my swing trading class here. We've won 15 out of our last 18 trades, and so we're going to hope to keep our good streak alive there. Also, on the sector selector, we do have industrials taking over the new top spot in the ranking system there. Now remember, the sector selector is something that I produce exclusively for my Monday top-down trend trading class. We use it in that class to help us make decisions, but I put it together on Friday nights after the market has closed, and so this would not have included any of the information that we learned in the last 2 days. However, it is impressive to see industrials rocketing higher from the 6th slot all the way up to the number 1 slot. Utilities held firm at number 2, but we did have a new number 3 as well this week, and that was consumer discretionary. So interesting rotations taking place there. We did see real estate investment trusts falling all the way down to number 4. We saw the consumer staples falling down to number 6. We saw healthcare dropping down to 10 and technology dropping down to 9. And a lot of that is as a result of what David and I were working with you guys on last week, that understanding of the rotation that was taking place below the surface of the market, where we had the momentum and the low volatility factors falling out of favor, and instead money was starting to float into value and dividend yield factors. And so all of that turbulence below the surface of the market last week did cause quite the rotations from a sector perspective, as you can see right here as well. All right, back on track here now with some Thinkorswim charts. since we were just talking about the factors, one thing I did want to share with you real quick, let me pull up my factor comparison chart here. Wanted to show you that over the last month, the value factor has obviously outperformed. The last 3 days, it has kind of just held the line and drifted a little bit lower. It was interesting to me to see today we actually had a resurgence in momentum and a resurgence in low volatility on a one-day basis. Now, of course, they're still the bottom 2 out of these 6 because of the struggles they had mostly just last week, but nonetheless, they did have a little bit of a pick-me-up here today, so we'll see if that leads to anything in addition. Real quick here, I wanted to show you the factor 6 grid here as well. There you can see the daily movements a little bit better than on that line graph that I showed you a second ago. And so here is the low volatility factor. You can see it had a pretty nice move higher here today. It was up 0.71% as far as how I track this particular factor. And the momentum factor was actually up even more than that. Momentum factor was up 1% today. Both of those are pretty strong looking candles there where we opened up at the lows and ended on the highs. So keep your eye on that story because you can see the value factor is actually sold off the last couple of days. Now, you know, it hasn't been dramatic. Keep in mind the value factor erupted higher last week, and so if this is all the give back that it's gonna do, we shouldn't be overly concerned about that. But it is true that we moved such a big amount last week that it's possible that we have to give a little bit of that back. So we'll keep our eye on that story, and of course talk about that tomorrow in my factor-based swing trading class. But a little bit of a return the way things were a couple of weeks ago here today with low volatility and momentum factors kind of picking up a little bit of the slack of value here today. All right, moving on now to another set of comparison charts. Let's go ahead and do chart the asset classes 12 grid. So on this, we can kind of get a sense of what's been working, what hasn't necessarily been working. Now, one of the enhancements to the charts is you will notice that we have some darker shades of green and some darker shades of pink here that we're dealing with. So anyway, just wanted to remind you of that particular enhancement. That'll let you know whether we have a strongly bullish posture in the form of the dark green, a strongly bearish posture in the form of the dark pink. Otherwise, like here's an example down below with gold, that lighter shade of pink there is basically a weekly bearish posture. So remember what distinguishes those two, whether you're talking about strongly bearish versus weakly bearish in an intermediate posture setting perspective, is where that intermediate line is on the market forecast. So notice here, the intermediate line is at 31 and falling. So anytime that's below 50 and falling, we consider that strongly bearish in the case here of foreign bonds. In the case of gold, it is still bearish because it's falling here, but because the reading is still above 50, we just consider this weakly bearish at this particular time. So as we look at these charts, you know, again, the big story of the last 48 hours has been oil. Mentioned that in the intro. Notice here that oil has had quite the give back here today after erupting higher yesterday for one of its biggest moves in quite some time. So USO is one of the ETFs you can use to track oil itself, and as you can see, it was down 4% here today. Pretty ugly looking candle there as well. Now we do have to remember yesterday's candle right there was after a massive gap higher, and so that doesn't tell the whole story, but you can see that we were looking at kind of a bearish engulfing type of a candle there. We do remain with a bearish posture here, although it is considered a weekly bearish posture. On the positive side of the equation when it comes to oil, we do now have a green moving average, so price is above a rising moving average. So it's possible we give a little bit of this back, but then start establishing kind of a newer support level around that moving average if that moving average continues to rise up to price action right there. I'll be very curious, by the way, to see if energy can ever get off of dead last from an equity perspective on the sector selector. It's been dead last for months and months and months and months. Well, with yesterday's big move higher out of oil and then the corresponding oil and gas stocks, I was somewhat hopeful that maybe, just maybe, this would be the week where energy goes from number 11 to number 10 or something along those lines. But then again, today with oil prices falling, that kind of throws a wet blanket on that idea. So we'll see what Friday brings when I kind of re-rank this on a sector selector perspective, but it has certainly been the story of the week, oil prices have. As you can see, there are some charts that look better than others on the board here. One that I would like to point out is real estate. Real estate popped nicely higher. This is actually its second straight up day. And remember what I mentioned a moment ago from a factor perspective. Low volatility factor did well today. Remember, there are a lot of REITs and a lot of utilities that have contributed to low volatility success, not just today, but in the full year of 2019. And so that kind of plays into that theme that we see right there yet again. And so keep your eyes on the REITs. They might not be the most exciting area of the market, but we've had a decent looking trend here. And yes, we gave back quite a bit last week, but we're showing some resilience here and we're bouncing nicely off of that 30-day moving average right there as well. So US dollar was down a touch today, but remains above a rising moving average. Gold was up just a touch today and is kind of riding that upward moving average right there as well. Treasuries, at least the treasury yields, were down a hair today. We did end with the 10-year at 1.81%, again on the eve of us going into our Fed decision here tomorrow. Let's take a look at another set of 12 grids here. Let's go to the U.S. sectors 12 grid. And as you can see right here, the staples are the only one with the pink chart. Now, note that that's the light pink color that we're looking at there. The intermediate line is at 79 and falling. And so, in other words, if this were at 80, it would actually be a bullish chart. That's how close we are to having a clean sweep across the board. It's just that the staples have fallen just a little bit there. There's a few stocks like Clorox and some of those household products companies did fall here yesterday, I noticed, and so that probably led to a little bit of a pullback there. But you can see that staples remain above a rising moving average, so it's possible that we're just kind of giving back some ever since having this overbought cluster signal here. But because we're kind of trying to stabilize right here above a rising moving average, it's probably not something you want to count out quite yet. Whereas the rest of the charts are all bullish, and not only that, they're the deeper shade of green in the background color. They're telling us that all of them are not only bullish, they're strongly bullish from an intermediate posture perspective, according to the market forecast technical indicator that you can find over on the Thinkorswim platform. You'll also notice that all of them have green moving averages. Some of the charts probably look a little bit better than others. Obviously, the chart in the from the utility perspective and in the real estate perspective starts in the lower left and ends in the upper right. Whereas a lot of these other more cyclical areas have kind of more of this drop off, that took place, like with the materials here, and then this big resurgence here last week. So the trend is not there with the materials, but because that resurgence was strong enough, you're now noticing that the moving average is curling higher there, both on the materials and also on the industrials. And I guess you could say the same thing really for, discretionary and energy and technology and communications and financials, because you'll notice that all of those actually had their moving averages trending lower for a big chunk of August. So it's a healthy sign to see enough upside price action where we're now starting to see those moving averages curling higher. You can also see that down below with healthcare as well. And again, healthcare was the sector that we discussed in length in my dividend growth investing class earlier today. So on the whole, U.S. sectors do look pretty strong here. Let's take a look at some of the major foreign markets now. And so I'm going to come on over here to our global stocks primary 12 grid. So note that there's going to be a primary version and a secondary version, so that way we can talk about several different outside markets here with these new charts that I'm putting together here for you, and with the help of some of our key students like Clarence and Marcia and others, of course. But anyway, this will be considered kind of our primary view here with the 12 major economies around the world, of course, starting with the United States and then going to China and Japan and Germany, etc. And then the 12th of these would be South Korea down here in the lower right-hand corner. Again, it's kind of similar to the conversation about what we saw there from a U.S. sector's perspective. We have a clean sweep across the board. Not only do we have bullish postures, but all of them are considered strongly bullish as it stands right now. So that's a healthy sign. Some of the charts look better than others. I would say that one that is leaving quite a bit to be desired is India. While we do have a green background color on India here, you can see that it has struggled a lot more than other areas. Now it is stabilizing here, so perhaps there's reason to be excited, but as it stands right now, India is just kind of hanging out just a hair above its moving average that's in the lower portion of its chart, whereas when you look at a lot of the other charts, for example, Japan, notice that Japan doesn't have the steadiest of trending charts right here, but it's trading up here near the highest levels of its 3-month period, and Japan stocks are up probably about 6% over that time period, at least in US dollar terms. And so that would be an area of interest for those of you that are looking for a little bit more bullishness out of the foreign markets. And then real quick here, let's stop by and take a look at the secondary 12 grid from a global stock perspective, where again we can compare it to the United States stocks in the upper left, but then the 11 charts that you see after that are kind of the 11 next biggest economies out there. So everything from Australia down here to Sweden. Here's a little bit different because we don't have a clean sweep of green charts. We do have some bearish ones out there. We have Indonesia and Switzerland as weakly bearish areas of the world, whereas we have Argentina and Saudi Arabia as strongly bearish areas of the world. And you can see that Saudi Arabia was up today, but it did touch a new multi-month low earlier in the session. Of course, Saudi Arabia has most definitely been in the news, much more so than normal here in the last 48 hours with some of those key drone strikes there on its oil refineries. And Argentina, of course, really fell out of bed here a couple of months ago and has just maintained its bearishness ever since then. On these particular charts, I would say that the one that's catching my eye as being the strongest is probably Taiwan. Similar to Japan, you're seeing that Taiwan is up here in the upper right-hand corner of its chart. It's actually up about 9% over the last 3 months. So again, the trend doesn't look all that consistent or smooth, but it is at least heading in the right direction here and doing so at a pretty healthy clip. All right, so with that information out of the way, let's now get into our trade application example. And for this, I am going to come on over here to our swing trading view. And I wanted to pull up ticker symbol XLE. And that, as most of you are aware, is the energy ETF. Now, it was very impressive what we saw yesterday out of a lot of energy-related securities, including this one. You can see a nice gap up yesterday. But of course today, not so exciting. You can see that XLE was down 1.39%, and this candle is looking like it's kind of losing a little bit of steam from the big resurgence that we had here, not just yesterday with the gap up, but you'll note that XLE had actually been in a fairly strong upward momentum thrust here really for the last month or so. But one thing I did notice starting to show up on many of these oil-related charts is a bit of a bearish near-term divergence that's setting up. And the near-term divergence refers to this blue near-term line on the market forecast technical indicator. So note that we have peak number 1 right there, and here's peak number 2. Notice that peak number 2 is clearly below peak number 1, and also note that peak number 2 is just a hair below that upper reversal zone there as well. So what we like to do is we like to see where is price in relationship to the underlying indicator on those key specific dates. So on this first peak right here, note that price was on this candle right here. Note that on the second peak right here, price was up here. So we went from here to here. In other words, price went way up, yet on the underlying indicator, we actually have lower highs that are being established. Now, of course, that can change with a number of things, especially in a situation like this where, a geopolitical, headline could affect oil prices up or down, dramatically on any given day. But with these near-term bearish divergences that we're seeing here, perhaps this is an opportunity to do something bearish. And you can see that we now have a pink background color chart here signifying that the near-term posture is bearish as of this moment in time as well. So what I thought we would do here on XLE is just do a fairly simple bear call spread. I've got it established over here on the trade tab already. You can see that I'm using the November contracts here for this, and I'm selling the $65 call, and I'm buying the $66 call. I'm receiving a credit of 25 cents for this, and remember, when you're doing a $1 wide credit spread like we're doing right here, as long as you have 24 cents or more in credit, you're receiving at least a 30% return on risk. So if you click on confirm and send, you could figure that out. In this particular case, with just one simple contract, we'd take $25 and we would divide it by $75 right over here. And you can see that that would be a return on risk of 33.3%. The other thing that's worth looking at while we're over here on the order confirmation dialog box is the break-even price is $65.25. Now, if you were to look at the chart and kind of look at where $65.25 is, it's approximately right in this general vicinity right here. So note that if you're looking at that crosshairs on my chart and you go all the way to the left with your eyes, that's clearly above that prior high there. So in other words, we've got a bit of a double top over here on XLE at around 64.50. And so if we take this trade here, we now have another reason why perhaps there would be some selling that would set up there from a technical perspective as well. So obviously you're going to want a position size appropriate for your own portfolio. We're just going to do one contract here just to give you the educational example of that. We're not going to get too overwhelmed with that just in case there's a big move against us. But we'll go ahead and confirm and send that, look at it one last time, and then ship that in. We'll see if we can get filled first thing in the morning. All right, thank you for joining me here yet again. Remember, U.S. markets remain bullish from a posture perspective, but of course, we've got a big news day tomorrow, especially with that Federal Reserve announcement. So make sure you stop back by tomorrow night and listen to David's analysis to see what sort of insight he gleaned from the Fed there. But for our purposes here today, the big news story was the give back in oil and energy related names, and that's what we are trying to take advantage of here with our trade application example. So if you got value out of tonight's video, make sure you go over and click like for us there on Twitter. We certainly appreciate that. I want to wish you all the best success with your trades and your investments. Goodbye for now.